Hi, this is Michael O'Leary from Buy the Book Taxes again with another video on IRS collections. This is a very important video that speaks to a very important concept that is not really well known by taxpayers. It's called reasonable collection potential, and it is how the IRS determines what a taxpayer's ability to pay is. Many times I'll get asked this question, both by my clients and by other people who aren't my clients. They'll say, I owe the IRS a certain amount of money. Can I just settle with them? Let's say I owe $100,000. If I call them up and offer them $20,000, will they accept it? And the answer is, it depends. The IRS uses a very specific arithmetic formula called reasonable collection potential. And I'm going to walk you through that today to explain how it works with an example. I'm going to share my screen. Okay. So the first thing you need to know when you're trying to figure out if the IRS will accept a payment from a client is how much does the client owe and how long does the IRS have to legally collect the debt. So in this example, I have a client who owes $175,000 to the IRS for a 2017 tax return that was filed April 1st of 2019. The IRS has 10 years or 120 months to collect a debt by statute, by law. So for this tax debt, there are 88 months remaining on the statute, assuming we did this as of November 30th of 2021. Very important. $175,000, 88 months. Now, there's two pieces to this reasonable collection potential concept. Think of it like a balance sheet plus your income statement, to, a little bit of accounting terms there. By a balance sheet, I mean, how much do you own and how much do you owe? So for example, you own a house, you have a car, you have a retirement account, say a 401k, you have life insurance, you have investment accounts. So here's how we do it. It's called net equity in assets. What do you own? What do you owe? So here's an example. This client has some cash in the bank. He's got a retirement account, cash value life insurance, a car, and a house. So you add that all up, it's about $815,000. Now the IRS gives you a break. They say, look, if you have to reduce all your assets to cash next week, you're not going to get 100 cents on the dollar. So they basically give you a 20% discount. You can take 20% off the market value of your assets. With the retirement account, you're not doing that. What you're doing is, that's a tax deferred account. So if you take the money out of that, you've got to pay federal income tax, state income tax, also maybe an early withdrawal penalty. Okay? So we don't reduce the cash. Cash is cash. We reduce the retirement account by whatever taxes you'd have to pay. We reduce the value of the vehicle by 20%. We reduce the sale value of the home by 20%. And then, so net on that amount of assets, the quick sale value is almost $640,000. Now you reduce that number further by any loans that are outstanding. There's a car loan, there's a mortgage, okay? So now the loans are almost $480,000. So the net equity is $167,000. You do get a couple more reductions. You can reduce the amount of cash by 1 month of living expenses plus $1,000, but not below zero. So you can zero out the cash, which we're doing. And then on the vehicle, you can reduce the vehicle value by an additional, I think this is like round numbers, it's about $3,650. So that's the net equity and assets. What do you own versus what do you owe? So by IRS calculations, this taxpayer has $160,000 in assets. The next concept is called future income. So now what we're looking at is how much income do you have on a monthly basis, and what are your living expenses on a monthly basis? The goal is to determine, after you take your income, reduce your living expenses, how much is left over to pay the IRS. So the IRS uses some combination of what are called your actual expenses, national standards, or local standards. The IRS actually gathers cost of living data across the United States. I think the Bureau of Labor Statistics and the Census Bureau collect a lot of this data, and the IRS has actually formulated it down to the county level. So over here are the groupings for the living expenses that they have. Food, clothing, and miscellaneous, they go by a national standard. Housing and utilities, which is the lesser of the actual or the local county standard. Vehicle ownership, you own or lease a car. Vehicle operating. Public transportation, health insurance, out-of-pocket health care, court-ordered payments like alimony, child support, dependent care, life insurance, current year taxes, okay? So for all of these categories, you're using some combination of the national standard based on the county you're in. The numbers I'm using here are a single parent who's divorced with 3 young children living in Fairfield County, Connecticut, where I'm from. So you have your actual expenses, you have the standards, and then you have what the IRS will allow. So we add these all up for all these categories, whether it's the national, the local, or the actual. And for this client, this example client, he's got $15,000 of monthly income, a little over $11,000 of allowable expenses. So the IRS says he's got $3,939 left over each month to give us. So the question is, now we have to figure out, will the IRS accept less than the full amount that he owes, or do they consider him a full pay candidate? So here's how we do it. Take the net equity and assets from this page over here, 160,000. Now you add that to what they call future income. So in this example, there's $3,939 per month above and beyond the allowable living expenses that can go to the IRS. You multiply that $3,939 by the 88 months left that the IRS has to legally collect this debt. So $3,939 times 88 months, that's $346,000 of future income. You add the assets to the equity, the reasonable collection potential that the IRS sees is $506,000 from this client. You compare the RCP to the amount the client owes. If the RCP exceeds the amount of the tax debt, the IRS believes the taxpayer is a full pay client and they will not compromise the debt. If, however, the RCP number is less than the $175,000, then the IRS will compromise the debt, and what you should offer the IRS is actually the RCP figure. So that's the number you offer them, and that's the number based upon their methodology, their model, that they will accept. Okay, so that's it. Reasonable collection potential. How much will the IRS accept in order to pay off your debts? I'm going to share my screen here in a second. I'm just going to put up my business card information. So if you want to reach out to me, here I am, Michael O'Leary, Norwalk, Connecticut. Phone number, fax, email, website, and on the back, here are the services I provide: tax preparation, 1040s, 1041 estate and trusts, and then all of the various tax resolution options, installment payment agreements, offer and compromise, currently not collectible if there's some hardship, innocent spouse, if there's tax debt left over from a divorce, penalty abatement. I can get penalties removed and refunded to you if you qualify, and tax liens and levies I can help. If you're looking to refinance a mortgage or sell your house and you have liens, and I offer CPA quality without CPA prices. So if you fit the bill for any of these, please give me a call. I can help.